everyone. Thank you very much for joining us for the second session of the FinTech Summer Sessions. We're now in week 2. So last week, my colleague Munira gave us a really good overview of what's happening and the updates in FinTech. And this week, we now start getting into deep diving. We start getting into the crux of all these different FinTech topics and why they're important. So today, we're really pleased to have Abdulaziz Sajja with us. He is the General Manager for Tabby. Abdulaziz, thank you so much for joining us today. We're going to be talking about alternative finance models for consumers. So I'm going to hand it over to you. We've got a presentation. Abdulaziz very kindly prepared a presentation, and then we're going to try and get through as many of the Q&A at the end as possible. So over to you, Abdulaziz.
Perfect. Thank you, Sagar, for the introduction, and pleasure always to work with Saudi FinTech and hopefully create an enjoyable and productive session. Hi, everyone. Thank you for joining us tonight. It's me, Abdulaziz bin Sajja. This is Saudi FinTech Summer Session Week 2. I'll be talking about alternative financing models as part of the Saudi FinTech Summer Session Weeks. Let's move on. Wait just one second. Yeah. So I'm the General Manager of Tabby. Tabby is a leading buy now, pay later provider operating across the GCC. Today, we'll be talking about alternative financing models and specifically on consumer financing models. What we'll talk about essentially is what is alternative finance, some development and history about consumer financing, examples of financing models or alternative financing models. What does that mean in terms of impact on consumer in the industry, and new trends that will be coming up the radar and you'll probably see very soon. Before we get into alternative finance models, let's understand what is finance and consumer financing specifically. For people that don't have a financing background, finance is usually, or what finance is really the study and management of large sums of money. And so what does that mean? So if you're a business and you're a CEO and you have 100 million riyals, you might ask a question, what's the best way to manage that 100 million riyals to get the most return or reduce the cost on handling it? And if you're an individual, a financial question could be, I want to buy a home. That home costs me 3 million, 2 million, whatever it is. Do I have enough money for that to buy that home? And do I, what kind of down payment do I put on it? How can I reduce the interest rate on that home? And for example, if you're an investor, whether a business or an individual, questions in finance will be, well, which stock should I buy? Should I buy this stock? Should I buy SABIC? Should I buy Aramco? Should I buy banking stocks? Which stock should I buy? And how long should I hold it? And these are the kinds of questions that finance can help you address. Now, consumer financing specifically is a branch of finance that is concerned with, so any activity that involves an institution or another individual extending a loan to another individual, that's usually for that is used for consumption. This is considered consumer financing. So for example, if you take out a credit card that you use in your travel or in your normal purchases, that's considered a consumer financing. If you go to a bank and apply for a personal loan to use to buy items for the home, for furniture and stuff like that, that's consumer financing. And also Tabby, what we do in terms of providing a buy now, pay later option, it's a consumer financing option. And so anything, essentially to simplify it, any point or any transaction that involves a entity or a person extending an amount to another person in the hopes of getting back that amount, that is considered consumer financing. And consumer financing could be identifiable or non-identifiable.
Recording in progress.
Identifiable means, for example, a mortgage or an auto loan. So if you go to a bank to buy, so if you go to a bank to buy a car, what you're going to find is essentially you are telling the bank that I will need a loan to buy a car, and that's an identifiable purchase. But for example, if you're using if you go to a bank and say, hey, I want a personal loan to use in several different purchases, then that's a non-identifiable purchase. The bank doesn't know what you're going to buy. Very simple, but very also critical difference you need to do because it has implications on the risk and all that. Now, what happened in the recent, let's say, 10 years is multiple alternative consumer financing models have developed, such as, for example, Tabby's buy now, pay later model is considered an alternative consumer finance because it doesn't involve a bank in the middle. And so it is provided to the customer seamlessly at the point of checkout. And we'll get into that soon. So what is alternative financing models? So to put simply, as I said just now, any financing that is not essentially provided by a banking institution is considered an alternative financing model. And why that is because for a long time, consumer financing was only provided by banks. You have to go to a bank, fill out a form, apply. The bank will then check your credit. You'll wait for a week or 10 days, and then you'll get an approval, and the amount will be credited into your account. That's normally how it goes, at least for personal loans. Same thing for mortgages, same thing for car loans. But with digitization, acceleration of technology, a concept called embedded finance, which is how to provide finance during the customer's own consumer journey. So for example, if you're shopping today and you don't have access to financing, then if you wanted to get a loan, you need to go to a bank, get that loan, and then come back and resume your shopping journey. But for example, what Tabby provides, or what we provide, is we will integrate directly to the merchant that you're shopping with. And then as you shop, you will find Tabby as a payment option. And there you can use, for example, buy now, pay later to buy something directly on your shopping instantaneously with no need to go to a bank, apply and wait. And so the Tabby is just an example here. There are a number of other alternative financing models that we can discuss, but this is just an example to help you say the difference between what is traditional financing and what is alternative consumer financing. And I'll get into sort of how and why it evolved from the way it is. So I want you to think or keep in mind the concepts of embedded finance, so financing within the customer's own journey, and financial inclusion, which is the ability to extend financing to a bigger portion of the population than it was before. Now, these are what I've listed out here are a bunch of examples of alternative financing models. I've listed out consumer and business financing. What we're going to focus on today is just consumer financing. And what Saudi Fintech has told me is that business financing will take place in a different session. So I'll go through it really quick, but I won't get into the details. So for consumer financing, there is buy now, pay later, similar to what I just shared right now, which is you shop normally on an e-commerce or an offline store, and then you choose Tabby on the checkout. And then you can essentially as a customer, get an approval instantaneously as you shop, as opposed to going out to a bank and applying for a loan, waiting for the approval and the money to come in, and then go shopping or go buy whatever you need. And then there is P2P lending or peer-to-peer lending. And what that does is essentially creates a marketplace between individuals like us. So if you think of individuals, there are people that are more likely to consume, and there are people that like to save up. So if you're saving a lot of money and it's sitting there in your bank account, you'd want to make some money from your own money. So you want to put it to work, right? So what P2P lending does is it connects savers to purchasers or users of that money. So for example, similar to idea, so for example, a person wants access to a loan, they go into a P2P lender or a provider or a marketplace, and then essentially they can get money from other people. So people will lend them that money and expect a certain return on that, right? And then, so this is very simply what P2P lending is. And then there is also lines of credit, which is very similar to P2P lending, but what it does, it extends the concept of P2P lending or peer-to-peer lending, not just between individuals, but also between individuals and institutions. So it creates a marketplace where you don't have to, as a customer, to go to a bank and get a loan from a bank specifically, you can essentially tap into a marketplace that has investors, banks, other financing companies, for example, other individuals, and essentially ask for a line of credit and ask for a line of credit as an individual, and you will get a line of credit from that marketplace versus getting it from a financial institution. So these are typically three good examples of consumer financing. On business financing, I will not get into the details, but these involve, invoice factoring, crowdfunding, merchant cash advances, and revenue-based financing, which Saudi FinTech will show in a different session than today. So how was consumer financing delivered historically? As I mentioned before, the consumer financing for a long time was only within banks, and essentially what you had to do was approach any of the banks that you know, and then apply for a personal loan. You apply and wait, so you fill out a form, you apply, you wait, and then within a week, several days, 10 days, depending on the bank or the speed of the bank, you get an approval, and then an amount will be credited into your account. I've recently been through that kind of process. It's usually lengthy, requires multiple visits, requires signatures and manual documentation for that process to actually complete. The challenges of traditional financing is it was non-dynamic, non-contextual. What does that mean? It means that the bank will look at your numbers outside of what your situation is. So for example, with Tabby, if you're shopping, I will know what you're purchasing and from which partner of ours you're purchasing this. So I have a very clear idea on the context on why you're purchasing what you're purchasing for. And so that gives me a lot more context to give a dynamic decision for you as a customer, as opposed to a bank which only sees a few numbers, like numbers of your credit report, SIMA, and stuff like that. And then it's a very checkbox approach with banks. So if you have a certain SIMA score, great. If you have a certain salary, great. If you have a certain whatever is great. And then they either approve or reject, as opposed to alternative financing options that look at different data points for you as a customer. And then different customers will have different solutions and different structures provided to them in a very customized approach. Now, what changed during back then and today is a lot of things. So digitization. So a lot of the processes within financial institutions, but also a lot of processes have been digitized, whether it's KYC, AML, stuff like Nafad that has digitized the way that people identify you or institutions identify you, working from home. So people expect that digitization covers a lot more of their aspects. And then the proliferation of APIs. And maybe a lot of you have heard API, but don't really understand what that means. API means how do systems talk to each other? So when somebody says, I want to connect my technology with your technology, these two technologies need to be able to connect to each other. So one of those players will say, hey, I'll share my API with you. And what that means is that I will give you a blueprint for how to connect to my systems in a way that we can both benefit. And so this has really taken FinTech to the next level, and we'll delve a bit deeper here, but it also led to the development of alternative consumer finance models. Now, what is the impact of alternative consumer finance models? Why, for example, do businesses like, for example, Tabby or peer-to-peer lenders or lines of credit, what do they do to the market, to consumers, to the economy, versus if we just kept it with banks? So for you as a consumer, we provide simply easier and faster access to credit. There's also the concept of increased financial inclusion. So if you think about yourself as a student, sometimes you won't be able to access credit. No bank will give you a credit card. No bank will provide you with a personal loan. And even as a student, sometimes you have your own purchase needs. And so Tabby, for example, will look at your past purchases and get an understanding of what you can afford to buy and all that, and potentially help you purchase the stuff you need. So alternative financing models increase financial inclusion. We are able to expand the population of the people we can serve. And not just Tabby, of course, but also other alternative consumer financing options. Personalized experiences. And this is very key because different people have different needs. If you, banks, for example, the way they segment the population, they segment them into very large chunks. So they will look at 500,000 people, for example, as the same customer. But more and more, smart fintechs are able to create customized individual solutions to individual customers. So you as an individual have very different needs from the other individual. And so if we can get more customized solutions to you, then that essentially makes you more willing to engage with me as an institution. And so customizability is very important. There is also more choice and flexibility in what type of credit do I look for. So for example, if you were looking to buy a home, typically banks are still very good at that. All right. And I can't see any other alternative consumer financing models, at least in the region, that are able to provide the same facility. So I might want to say, hey, go to a bank. Tabby can't do this for you. But if you're looking, for example, for an easy consumer purchase, I want to buy, for example, an airplane ticket for my next holiday or something like that, you don't really need to go to a bank. You could use Tabby to essentially buy a 2,000 Riyal ticket and split that amount into 4 equal installments. Typically, banks charge interest. We don't charge fees. And so that makes it very different. And it essentially expands the product, the products that you as a consumer can get in the market. For the economy, also, it's always, I'm always a very big proponent of competitors in the market. So for example, if we had one telecom institution in the country, potentially productivity isn't that great, services are slow, but as you increase competition in the market, what happens is you always have lower prices. So for example, lower interest rates, because if I'm competing with banks on consumer financing, banks are more likely to create more products that customers love, lower their interest rates, and so on. There's more choices for consumers and businesses. For example, a business might want to do this and not do that, and generally reduce the risk of financial instability. And what that means is there are a lot more players in the market to provide consumer financing, which means that the customers, if one institution fails, there's another institution that takes its place and essentially have a lot more access to the market. A few really quick points are, increased competition, new products and services, improved customer service, data-driven lending, and all that. So these are points to consider when you're thinking about what is the impact of alternative consumer financing models. Here, I just wanted to share a few examples of maybe names that you've heard of. So you have POS lending providers like Furas, factoring like Lendo, for example, and these are mainly business focused, so I won't spend time on them. But also BNPL, you have Tabby, Spotty, etc. You also have digital microfinancing lenders like Imkan and Tasheel. You also have a new concept that you'll probably hear about very soon, which is Save Now, Buy Later. A company called Sav has already started in this space, and potentially a lot more examples. Now, in KSA specifically, what led to this increase in fintech, and not just in alternative financing models, but also in alternative financing model, but not just in that. So the increase in fintech companies is a number of very important changes in the country. For example, the regulatory environment. SAMA has created, SAMA, which is the central or the Saudi central bank, has created something called the sandbox environment, where if you have a new fintech idea and you want to test it in the market, SAMA has created an environment for you to test that idea there. And what you need to do is go to SAMA's website, see how you can apply to the SAMA sandbox, and then fill out the application form and hopefully get accepted into there. And then you can test your idea with very minimal regulation, just to help young startups and fintechs get up to speed. Second thing is digitization across the ecosystem. And that's still happening very strongly. So for example, today, if you want to open a bank account, you don't have to visit a bank. You can open a bank account sitting in your own home and the bank will know who you are, what your number is, who owns your phone number, and all that, just digitally as you sit in your home with services provided by e-government providers like Ilm, Thiqa. These two companies, for example, provide a lot of that infrastructure when it comes to KYC, AML, digitized customer onboarding journeys, and all that. So that's really helped the entire ecosystem. And then more importantly, the availability of early stage VC funding. So maybe 10 years ago, or even less than that, if you had an idea and you didn't have the money, there's nobody out there that's willing to give you the money to test out your idea in the market. But today in KSA, there are multiple VCs or venture capital companies that have popped up and started and established in KSA that have the money to essentially invest in your company and help you grow. And we've seen both private VC and public VC help here. So for example, if you think about public VCs like Jeddah Fund of Funds or SVC, these are enablers and investors that will help even private VCs to access more and more capital to help startups like some of you who are interested in getting into fintechs or interested in creating their own companies. The challenges that I see still happening, and of course, whenever we hit a new growth stage, there are always challenges. But there's still the regulatory environment, in my opinion, is still conservative when it comes to some of the rules and regulations around it. We've been working with the central bank, and a lot of those rules have been either will be taken care of or will be looked at to enable even more and more startups to essentially enter the sandbox environment and grow. But this is still a challenge. There is lack of funding, still a lack of funding in later stage growth companies. And what do I mean by that? So if you're a company that needs $1 million or $2 million to start, there are multiple VCs in the country that are able to help you. But if you grow as a company, and then let's say you're growing, your company is doing really great and all that, and you're looking to essentially get more money to grow. Let's say you're looking for $70 million, $100 million to essentially take your company to the next level. There is much less later stage funding than early stage funding. So which we call later stage means at a later stage of the maturity of your company. And so this is still a challenge that is being addressed currently, where there are less VCs that are able to help you at that later stage. And then the last thing is, of course, availability of experienced talent in areas like risk, data engineering, software development, product management. And of course, all of you know that Saudi is a very young country. We have a lot of young people that are hopefully going to fill that gap in the next 10 to 20 years. But today, if you're looking to start up a fintech company or any tech company, and you're looking for senior talent that has done a lot of work in that area, you will run into this issue where there is a lack of experienced talent, but that is also a part of the natural evolution and growth of the country. So we'll catch up, but if you're ever scaling, you'll notice that, and there are ways to go around it. So now what I want to dive deep into is, or not dive deep into, but I want to talk about is new trends and opportunities in alternative financing space. So what we think, apart from the things that I just talked about, which are enablers in consumer financing, there are new trends and opportunities that will essentially move alternative financing to a whole new level. So open banking, if you've ever heard about that, from companies like Lean and Tarabot, Single View and all that, what they do is they will connect to banks and then provide that information to alternative consumer financing companies to essentially create even more personalized payment solutions, faster responses, better credit decisions, and all these things. Advancements in AI. I'm sure all of you are seeing what is happening in the AI space. ChatGPT is essentially changing the world, and it's just getting, and the pace of growth and change in that is getting really, really fast. For example, Tabby uses AI and machine learning today in its credit rating or risk algorithm to be able to choose which customers to accept and which customers to reject based on a number of data points. And of course, the localization of data cloud centers. So Google hopefully will open up its first data center in KSA by the end of September this year, if I'm not mistaken. And what that will do is it will reduce the latency between services. And latency is an important thing. So if you're working with customers, customers always expect for services to be instantaneous, very fast, respond very quickly to your clicks, to your requests. And the farther the data center is from where your company is operating, the potentially slower traffic between that. And then you'll have your customers waiting a bit more. So localization of data centers will help essentially not just reduce latency, which is the speed between when a customer clicks and when they get the output, but also keep your data more private, more secure within KSA. And then maybe a future outlook on what is a potential, in my opinion, what is the next wave of fintech startups that you will see is the same way that Tabby and BNPL has served the consumer financing segment. There's still a missing gap in SME lending that is starting to be addressed by potentially other different startups. But as I've shared previously, a different session on SME lending essentially and business financing models will be discussed at a later session. Now, if you want to know more about this, there's no other way than to essentially follow good articles or good business journals, especially ones focused on fintech, especially ones focused on tech in general. So I normally scan sources like payments.com, which is a very good source for anything that happens in the payments and financing space. And then TechCrunch, which really includes anything in the tech space in general. And then you have multiple different sources. LinkedIn is a very good source if you find where there are multiple entrepreneurs and multiple sort of fintech enthusiasts that talk a lot about fintech and talk about a lot about what technologies are out there that you might want to follow. And of course, Saudi Fintech always publishes a number of either backlooks on what happened during the year and all that, that keeps you well aware of what's happening in the industry. This is essentially the extent of my presentation. Thank you all for listening. I'll open this up to questions. I'm sure a lot of you might have questions and better to give you most of the time.
Elise, thank you very much. That was a great presentation, extremely insightful and really helpful. So we have a lot of questions. I am going to answer the questions around recordings, around certificates at the end. I just wanted to focus right now on the material that Abdulaziz has shared. The first thing, and this has been asked multiple times, is so Tabby doesn't charge interest. So could you explain how buy now, pay later works compared to traditional forms of finance? And then also, how does buy now, pay later actually make money?
Sure. So the way buy now, pay later works is we do not charge the customer any interest, but we do charge the merchant a commission. And the way you want to think about this is, for all of you, why would a merchant, for example, accept a higher commission on a payment service like Tabby? Is because with the ability, so what Tabby provides is the ability for customers to purchase from this merchant. And with that ability, we essentially increase the traffic to that merchant. We increase the potential checkout or the payment amount that the customer is willing to put. And so that is essentially like, if you think about it, it's more like a marketing service for the merchant, which we can charge a commission on. And so we don't make money from individuals, but we do make them from our partners.
Great, that's clear. So the customers, they wouldn't pay any different to where, if they went directly to the store, correct? Going through Tabby, they wouldn't pay any different, and the installments still equal the total amount of what they would pay. So if I'm paying 100 riyals for a pair of shoes, if I went to the merchant, I'd pay 100 riyals directly. If I went through Tabby, I could pay 25 riyals in 4 installments instead. It's exactly the same price.
Correct. So you'll be paying 25, 25, 25, 25. So a total of 100 with no additional money on top of that.
Right. And taking that example of the trainers of 100 riyals, the merchant might then pay you pay Tabby 10 riyals and as a commission, and they keep the 90 riyals for themselves.
Yeah. So a very simple example is, for example, the customer will pay me 100 back, which is exactly the same amount that they checked out with. I will transfer to the merchant 90 riyals, and that 10 riyals is my commission from that sale.
Got it. That's clear. A few other questions just on buy now, pay later as a sort of concept. Sharia compliance, is I guess this considered Sharia compliant?
So I think so. Yes. So we've definitely gone through our Sharia compliance partners with our Sharia review board, and the fact that I'm not charging the customer any interest. Essentially, this is a fee-based service. Which me and the merchant have pre-agreed on. It's essentially similar to a payment gateway. So how do payment gateways charge? They charge per transaction. Tabby also charges per transaction the merchant and doesn't charge interest on the customer.
Right. And what happens if a customer can't pay or they pay late? What's sort of the process for that customer?
Sure. So if a customer fails to pay on time, essentially what we do is we will start multiple things, right? So we usually remind the customer 5 days prior to the payment that they have a payment to pay, whether it's through SMS or email, and then another time 2 days before, and then another time on the day of the due date. And then after 1 day from the due date, Tabby will charge a late fee on the customer, so which is around 15 riyals. And the why we charge that is because after that date, after you have missed your payment, Tabby has a team of collection agents, and those collection agents get activated. So they start calling customers, they start to follow up on the payment, they start to find ways for you to essentially delay the payment or pay it at a specific date, and that costs us money. So we just offset that cost by adding a 15 riyal on top of the purchase.
And if the customer can't pay at all, then I mean, this is still considered credit, right? So it is going to have an impact on their credit rating and such.
Exactly. So if a customer can't pay at all, what happens is we are bound by the laws of KSA and by what the central bank also imposes on us. And so we are connected with the SIMA, which is the Saudi Credit Bureau. And I definitely advise everyone here to be very familiar with SIMA, their credit score, how to maintain a very good credit rating. And so if you do not pay on time, then we're obligated to report back to SIMA that you have missed your payment, which might affect your credit score in the long run.
And in terms of default rates, I don't know if you can shed any light on what typical sort of default rates look like in buy now, pay later compared to maybe other forms of finance.
I mean, if we look at, there's been a significant change in default rates from the day Tabby started to today. So, and this is very normal because when you start, you have extremely small amount of data that is not enough to train your AI model on. But as you get more and more data, you have more information on your customers, you have more information on the types of transactions, and your risk model becomes much better at selecting which customers are good, which customers will not pay on time. And so today with buy now, pay later, default rates are very, very close, even less so than bank credit card rates, which is great for us, great for the industry as a whole as well.
And just one question around you mentioned about selecting customers. Tabby's got better at sort of selecting customers. So how do you typically do that? What sort of models do you use to choose what are the right customers to be able to select? Because you can't really differentiate in terms of interest the same way that a bank does. So a bank might charge a higher risk a customer higher interest, where because you don't charge interest, it doesn't work for yourself. So how do you first decide on the customer, and how do you then manage the risk profile of a customer?
Sure. Well, I think if you look at buy now, pay later, is a very, is very different than traditional lending. The amounts are typically small. So you're not talking about 20,000, 25,000, 30,000 up to 100K. You're talking about amounts ranging between the 200 riyals to typically 3,000 riyals. And so what we care about are two main things: fraud and credit worthiness. But fraud to us is really key, number one. So if I know you as a customer, I'm comfortable with you, I know your identity and all that, that makes you very comfortable. Also, with typical banks, all the information they have is essentially the movements in your bank account and your CIMA score. But what we have access to is a lot more than that. So we do have data points that are concerned with your digital footprint, your email address, what's happening with that. Is this a new email address? Are you a fraudster? Typically, for example, if somebody's created an email address a week before and then try to use Tabby, they won't be accepted, because that's, for example, a very that's typical fraudulent behavior where somebody wants to make a quick buck. So it's these data points, what we call alternative data points, are what is used in alternative consumer financing solutions and making them much better at selecting customers and providing customizable plans.
Excellent. And just one final question on buy now, pay later before we talk more about alternative finance. Why 4 installments? Why not 3? Why not 5? Why not 10 installments?
No, that's a very good question. I think what we typically see as Tabby is that at 4 installments, beyond 4 installments, the unit costs potentially of providing a free of charge service become very challenging, because there is also the cost of extending money. So there is in finance the cost, what we call the opportunity cost, or the time value of money, is a very real thing, and there's a cost to the extending of money. So if I give you 2,000 today, it's worth a lot more than you paying me back the 2,000 in a year from now, because you have inflation, you have a lot of this stuff. I could have also used the 2,000 in different sources. So what we've seen is that at 3 months, that is sort of the edge of what we think is economically feasible. And beyond that, then we'll need to start thinking about charging customers. And to us as Tabby, that defeats the purpose. We still don't want to charge customers. We want to make this as free as possible. And so we think 3 months is adequate.
Excellent, thank you. And so just thinking about other alternative finance models, you mentioned save now, pay later. So how does that work, and how is it different from buy now, pay later?
So I haven't seen applications of that in the market yet. I've heard or maybe seen one company that has announced its launch. There's a company, and I think I shared the logo, is called Sav in the UAE. I haven't seen any applications, but what I think the model, or how the model works, is essentially they will, similar to what we do, they will connect with partners in the hopes and tell those partners that, we will bring you a very, very high volume of customers. Those customers will commit to buying a certain item, but the way they will buy this item is through, 4 months of savings. And what happens is that the customer will connect their bank account. At each month, an amount from their bank account will be deducted as savings, and then at a point of time in the future, they will have racked up enough money to buy that item. And so instead of buying now and splitting the cost over time, and then paying, for example, or the next 3 months, you save up to buy that item. And so it has different economics, has different use cases. Some customers might prefer that over buy now, pay later. Some customers will still say, no, but the purpose of buy now, pay later is for me to be able to buy stuff that I need today and extend that amount over time. So yeah, it's a different use case that will be interesting to watch.
Absolutely. And generally, alternative consumer finance models, they provide easier access to credit, right? They allow customers to be able to get access or more flexible access to credit.
Yes.
Do you see any risks related to that? And if so, what sort of, how do you go about mitigating those risks as well?
So I think so if you look at a lot of alternative consumer financing models, what do they try to achieve? They try to achieve a very easy, smooth journey for the customer. And as much as they can, make the credit decision as instantaneous as possible and as automated as possible. But the danger there is, like any AI model in the world, garbage in, garbage out. So if you put in really bad data into your risk model, what you're going to get is a model that doesn't work. And what that means is that you'll end up selecting a high number of what I would call bad customers that will default on your payments. And essentially you will have an unfeasible model. Because if you think about fintech is not a very high margin business. There are no fintechs out there. Even if you think about very big fintechs like Revolut and all that, Revolut only became profitable because of the increase in the interest rates we've seen in the market. And what fintech looks at is a high volume of transactions at a very, very thin margin. So you cannot afford, we cannot, for example, as Tabby, afford to have defaults go up to 20%. We need to keep very close eye on our risk model, ensure that it's really optimized and be able to select. So I think that's the risk that you run, which is through automation, the dangers are, are your systems secure? Can they be hacked? Can they be penetrated? Is your AI model generating the right decisions? Is it not? And so on and so forth.
And it seems that with these alternative finance models, we're moving towards finance being provided faster, real-time, accessibility. Does that create, and as you said, technology needs to catch up, needs to keep up to date with being able to give credit score in real time, being able to collect the information in real time to make sure who you're connecting with. Is there sort of a race in terms of just providing speed and efficiency for consumers? Is that where you see a lot of the focus for these alternative finance models moving?
Yeah, I mean, I do see that. And also not just so, if we think, for example, about, and I'm also always going to quote Tabby because I work there, and it's easy for me to understand where we're going, but speed and efficiency is one thing, but also being able to understand where the consumer is in their life cycle and then addressing that need at that point exactly. So let's say you're able to provide all kinds of financing. At a very young age, a consumer might need, to buy a shoe or a t-shirt. That's, at a very early stage in their life. And then they get to college, they might need access to a student loan to get them through college. As we've seen, for example, like companies in the US, like SoFi, that have completely revolutionized the student loan space. And then as a student graduates from college, gets to work, maybe they want to buy a car. So you need to also provide an auto car loan. And as they grow and get married, have kids, they're looking at a mortgage and beyond that and stuff. So the ability to look at a consumer from a life cycle perspective, not just from one point in their life or not just one transaction, is very key. And the better alternative consumer financing companies get at doing that, that's what gives them the edge over banks, because banks are typically a reactive institution. They will wait for you to come to them. But what if we nudge the consumer? What if we know, for example, oh, I've seen, for example, that you have a need in this part to plug this, for example, deficit in your cash balances. We can provide you with this service or product or whatever. And I think that's really the key here. And this is really where AI comes into place. The ability to not just tackle the financing need of the customer, but when to tackle that need and how to tackle that need is very important.
And do you see, I mean, we talk about AI, but do you see a role for, say, blockchain into this as well, in terms of being able to use these technologies to make it a more efficient process for consumers?
Oh, absolutely. I mean, if we, at least so I'm not, I haven't delved deep into blockchain, I'm afraid. So I'm not gonna, let's say, just talk rubbish. But one sort of, one point that I can think about is part of the security that a lot of financing companies have on hand is a promissory note. And promissory notes are typically today, there is an electronic promissory note, but the way it's done, there's a lot of interaction between as the customer onboards to essentially sign an e-promissory note. We've opted out of it just because the amounts are small and it doesn't make sense for us to use. But what blockchain can do is essentially make that extremely efficient and essentially have a smart contract set up where a customer can agree to a smart contract that if at an event time, at a point in time, it triggers an event automatically without having the company to do anything manually. And I think blockchain can definitely be embedded in all this in a smart contracts approach to make all of this automated as opposed to having to trigger a lot of this stuff manually.
And I think the other part I just wanted to, there's a couple of questions related to embedded finance. So we've got a session just on embedded finance, but I think it's really important if you could just explain how alternative finance models work in an embedded finance environment.
Sure. The way I simplify embedded finance is it's really the word embedded. So it is embedded in your life. So if you think about, again, if you think about Tabby, if you, in a typical, let's say, if you wanted if you were going on a holiday, for example, and you wanted to essentially buy your next hotel or a plane ticket on credit, what you would need to do is essentially go to a bank and apply for a credit card or a personal loan, and then get the amount in your bank account and then buy, right? But what embedded finance does is it really embeds itself in the customer's normal journey, because those decisions typically happen at the point of sale. So what you say, you want to buy a ticket, and then you realize, oh, I don't have enough cash in my bank account today, but I could have enough cash within the next 2 months. So I need something to bridge that gap for me. And when that happens, you start to think, okay, maybe I'll go to a bank and get a loan or a credit card. But that typically takes you out of the journey that you're in already. And you might miss out on a flight deal or a hotel deal. What Tabby does is we will integrate into that merchant or partner, and you will shop normally. And then at the point of checkout, you will see a payment option that says, split that ticket or hotel free of charge on 4 equal installments. And that bridges your money gap for the next 2 months. So it's really embedded within the normal customer journey.
Excellent. No, thank you very much. Abdulaziz, thank you very much again for the presentations and for the questions. We still have a lot, and apologies we couldn't get through all the questions today, but really appreciate your time. And as Abdulaziz said, week 3, so next week, we're going to be tackling alternative finance from the SME angle, so from companies. What alternative finance models are available to companies out there as well.